In this week's Property Insider chat, Dr. Andrew Wilson discusses the multiple factors the Reserve Bank takes into account when deciding what to do with interest rates. And there have been some changes over the last couple of weeks that could make a difference. We're also going to discuss what's happening to regional property markets around Australia and the latest auction results to give us an indication of what's happening on the ground. If you want to keep up to date with our housing markets, please subscribe to this YouTube channel and click the little bell icon so we can keep you updated each time a new show comes out. What's ahead for interest rates? At the beginning of this year, many predicted interest rates would start falling by mid-year, and this encouraged many property buyers and sellers to enter the housing market. They wanted to get ahead of the pack. In fact, our biggest lender, the CBA, at the time predicted a total of 6 interest rate cuts this year and next year. And then over the ensuing months, sentiment changed, and the predicted interest rate drop was pushed further and further into later this year, and then maybe even early next year. And all of a sudden, there was talk about rising interest rates. But only a few weeks ago, as part of the federal budget, Treasury predicted interest rates could fall to within the Reserve Bank's preferred range by the end of this year. So what's really going on? And will interest rates remain on hold, go up or down? That's what I want to ask Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. And I'd like to get some of his thoughts on the many factors that the Reserve Bank takes into consideration when deciding what to do with interest rates. Hi, Andrew.
Yes, good day, Michael, and happy end of autumn to you, I suppose we would
Yes.
say, and welcome to imminent winter time. And the weather down here in Melbourne is a little chilly, but certainly nice and clear and sunny, and we love that in autumn, don't we?
Well, as I've just read, we're 40% through the year. I can remember when we did our beginning of the year
Yes.
property insider chats. Lots has happened, and I guess it's now the winter season for the property markets.
Yeah, still a little bit of time to run for the autumn selling season. I guess the notional autumn selling season has finished, but we still have reasonably active housing markets running all the way through most of June as well. And it's really July where the market starts to track sideways and is significantly distracted. So yeah, it's been a positive, you'd have to say a positive year so far for most housing markets, a couple of exceptions, but certainly we've seen some strong growth in some of those capital city markets. But yes, we're into June, and the next Reserve Bank meeting will be in 3 weeks' time, in the third week of June. It's a little different this year, of course.
Yes.
So it won't be the first. It won't be the first Tuesday of the month. It will be the third, or it will be the second Tuesday of the month, but nonetheless a little different. But the Reserve Bank, it's been, as you said, the sentiment around interest rates has certainly shifted, has been quite volatile this year. I think a lot of it's been headline driven, and really, those that have been, and we've discussed this, that were predicting lower rates, certainly didn't have any data to support them. And I just think it was, other agendas that were driving that particular headline. And as the data came through, of course, that proved to be correct. In fact, we were certainly nowhere near out of the woods in terms of rising inflation, and we sort of saw that as the data came through. Our inflation rate, the global inflation rate, is particularly exposed to the price of oil. We'll have a look at how oil is tracking currently, and oil prices certainly broke above the sort of levels that we would expect to see inflation easing. In fact, we had the price of oil above $90 US a barrel at one stage, and of course that was what was the catalyst for higher inflation and the catalyst for a discussion not for interest rate cuts but for interest rate rises. But the latest data on the price of oil has improved, and I also think the Reserve Bank has given a few clues as to its view of the outlook for interest rates, particularly in relation to cuts going forward. But yeah, I think the media and those that have been forecasting lower rates. Again, the banks get it wrong. I mean, how consistently inconsistent are the banks in terms of their forecasts for interest rates in the housing market? I don't know whether there's a strategy behind this or whether they're just incompetent. I think we'll leave that to others to judge. But certainly, there's been some developments, Michael, over the last few weeks that have certainly changed, I think, the outlook for interest rates. And that's not just the data that's come through, but I also think the Reserve Bank's been a little bit more dogmatic in terms of its view for interest rates going forward. So shall we have a look at some of those statements that the Reserve Bank has made recently?
I think that's going to be important. One of the mandates of the new Reserve Bank governor is to be more transparent, have
Yes.
more meetings, and tell us what's the thinking behind their process, Andrew.
Yes, well, as we saw with the at the last meeting, the May meeting, the governor said quite clearly that that the path of inflation is certainly uncertain. It looked like with that data, the latest data that we had, which of course was the March data, which showed an increase in inflation, that the data that inflation was perhaps moving a little bit more slowly towards its expected meeting of the target range than was predicted. We will be getting in the next few days the April inflation rate. I think that also has a chance to be, again, a higher rate, but certainly not sustainably or markedly lower. And that's only because we're looking backwards in terms of what oil has done, the price of oil has done. But the Reserve Bank governor was quite clear in her statement that that they were not ruling anything in or out, in terms of what's would happen with interest rates, either up or down. She's quite clear about that. And I think that was the first real sign that, the cold shower that those were predicting lower rates might have to deal with higher rates. But as I said, I think the data has improved since then, and we can be a little bit more clear in terms of perhaps a stable outlook. Also, as you mentioned, Michael, the part of the new mandate for the Reserve Bank has been some clarity, and that's the press conference that the Reserve Bank governor has after the meeting. And I just picked out a couple of the questions that the Reserve Bank governor answered in that press conference, which I think that really did act, as I said, to clarify the thinking of the Reserve Bank. They said the governor said we didn't think it was necessarily to have to tighten again, so they're not really thinking they're going to have to tighten again, even with that higher data. But they can't rule it out, and that's fair enough. And they will if they have to. But I think this was, I think the clear part of this answer was that the governor said that if they thought that inflation was going to be, and I think this is the key phrase, persistent and significantly above our forecasts, we will tighten again. I think that means really it's not just going to be a couple of months of higher inflation, Michael. I think they would have to see a medium-term trend of higher inflation before they considered tightening again. And I think that was a very pointed statement from the Reserve Bank governor that, they need to have, that they would be looking for a longer-term increase in inflation before they decided to tighten again. So they really are in that realm of wait and see, or holding where they are, over the medium term. And in relation to all the media we were getting for expected rate cuts, which was just nonsensical, those that were predicting that given the macroeconomic circumstances, as we've discussed here. But one of the questions from the media at that press conference was, and I quote, "What do you say to people who are expecting and budgeting for a rate cut by the end of the year? What is your message for them?" So this was the media saying, well, what about those poor people who were buying into the predictions of a rate cut? And the governor, really shot that down very quickly and said, I hope I didn't give them any impression there would be an interest rate cut by the end of the year. I certainly don't believe I ever gave people that impression. So that was really the end of the speculation on interest rate cuts. And I think that was a very pointed response from the Reserve Bank governor, that there was never any indication that there would be rate cuts, and I thought that really sat that question down generally from the media. But I'm sure if we had any other soft signs of lower inflation, that we'd be running again with the lower interest rate story. So the point is here, please don't make decisions based on what you're reading in the media, and particularly in terms of interest rate outlook, because it is just headline generating interest type of speculation, and the Reserve Bank governor has quite clearly said there that there's been no indication from the Reserve Bank that there would be rate cuts this year. But of course, those that make these predictions, they can quite easily just turn around and make a new prediction. And that's the question for those that say, well, what about, the interest rate cut prediction? Oh, well, you haven't seen our latest prediction, which is completely different. So, buyer beware. Those that are making decisions based on what they're reading in the media, particularly in regard to interest rates, have to be very, very careful and circumspect about that. But as I said, it is important to understand the clear connection that we have between the price of oil and inflation. And of course, we have a chart that shows that relationship, and you can see how inflation quite clearly tracks the changes in the price of oil. And we did see an
Yes.
uptick in the price of oil over the end of last year and into this year. And of course, that's pushed the inflation rate up. It's a very robust relationship, Michael, and it's almost as though that's what's driving inflation. We can sort of forget about those other factors and keep our fingers crossed for oil.
Well, with the lag, I think it's got to be pointed out here. So as oil prices rise down the track, inflation goes up. That's right. But the price of oil is easing at the moment, Andrew.
Yeah, good news for the outlook for inflation. This is also part of what I was discussing, Michael, with the latest data coming through. It is certainly positive for better outcomes for inflation if we are looking to get back to that target range. Price of oil has now fallen below $80 US a barrel, Michael, which is quite positive. As I said, we were above $90 US a barrel just a month or two ago, and that's what's pushed up the price of the inflation rate has been that price of oil. And we don't have to tell consumers out there because, Bowser, the price of petrol at the Bowser now is down to $1.60, $1.70 in some states. And it was pushing up towards $2.50 not that long ago, Michael. So that's really, I guess, our key inflation indicator and interest rate indicator is have a look what's happening at your local service station, and they'll tell you what the outlook for interest rates are. But certainly good news. Let's hope it's sustained. Just an aside.
Of course, it's more than just the price of the Bowser for average Australians. There's the spin-off effect with all the transport and the fact that everything has to be taken to the end destinations from warehouses, from manufacturing. So the price of oil works its way through many things, Andrew. But there's a whole matrix that you at my housing market have put together about the decision-making variables. Can we have a look at those, not just the price of oil, to see what the Reserve Bank is going to be considering?
Well, I thought it was interesting, Michael, if we just put together some of these factors that we do discuss on the show here consistently, we look at the data as it comes through just to see what's happening at the moment and maybe have a bit of I guess, a measure of what that means for interest rates. So let's go through them. Certainly our latest inflation data was higher. It has been a concern. It did activate a discussion that perhaps rates would have to rise. Of course, our inflation rate is higher than the US, so that's already a negative factor in terms of our interest rate settings, which are actually lower than the US. But our latest inflation data, which I mentioned, was for March, which was higher, and that certainly gives upward pressure on interest rates. But we will have the latest inflation data coming through in coming days for April. We will have to still target a higher petrol price or higher oil price over the year to April. So we won't get any significant relief per se. And I think we still have other factors that are going to be pushing inflation upwards. So let's say that there's, on current data, the prospect is for higher rates with the inflation data, which has been rising. But the oil price is easing, Michael, which is good news. I think that gives us a steady outlook as it currently stands for interest rates. House building costs, as we've shown on the show, have continuing to fall and are certainly the lowest they've been since this very strong increase cycle of the past 12 months or so. So that's steady, still high. So I'd say steady outlook for interest rates on the basis of house building costs. Unfortunately, home rents are still rising, and that will play itself into higher inflation and therefore upward pressure on rates. The jobless rate is higher. Marginally higher now, over 4%, but still very low at that 4%, really reflecting a full employment economy. So upward pressure on rates from that very strong economy with low interest, with low unemployment rates. Wages are still rising strongly, down a little bit, 4.1% over the past year versus 4.2% in the previous period. So upward pressure on rates still from those rising wages, of course, unless we get productivity gains to cover rising wages or strongly rising wages. Then employers have to pass on those extra wage costs with higher prices. Retail sales are lower, still high, but the trend is now certainly starting to ease for retail sales, but are still quite high through that and reflecting that COVID stimulus package period. So I would say that's steady outlook for rates. Strong house price growth is continuing in most of the major capitals. I think the Reserve Bank has had a bit of a focus on the housing market, and perhaps they'd be unlikely to cut rates given that focus on the housing market, with fear that it may contribute to higher prices and lower affordability. So I say that's a steady outlook, given house prices still growing. It's a steady outlook for rates. Our rates are still below the US, as I said, but our inflation is higher. So regardless of the outcome in the US, I think that's steady. And it has been, not just in Australia, but in Europe and the US, an easing of that recent focus on rate cuts, which went from, as you mentioned, the Commonwealth Bank were predicting a number of cuts this year and have now predictably backtracked on those predictions. Similarly, in the US, they were predicting 7 rate cuts this year, and they're now down to 1 to 2, perhaps. So steady in terms of what's happening internationally. Our economic growth is certainly started to slow, so that really gives a lower interest rate initiative there with lower economic growth. But of course, we've seen those budget initiatives, as we've discussed, to reduce the cost of electricity, which Treasury have said will bring our inflation rate into the target range, perhaps as early as the end of this year. So that's good news for interest rate outlook. And then again, I suggest that that's a steady relationship with the outlook for interest rates, because it's not just electricity costs, of course, as we've looked at this matrix, that is driving the outlook for interest rates. So look, I think overall, Michael, I think that shows us quite clearly that the bias going forward for interest rates is still steady. And I think that reinforces what we've seen, or what we've heard from the Reserve Bank governor. I think that they'll be very unwilling to, in the shorter term, to increase interest rates. And I think they're quite happy to leave rates where they are. And let's remember, our interest rates are still lower than where they were at the peak of the previous cycle in 2012, which was at the high point of that big mining boom that we had.
Well, it's only a couple of days till the end of the month, and we're going to have the latest My Housing market report for all our capital cities. It'll be interesting to see what's happening. But what's happening in regional cities around Australia? How are the housing markets performing there, Andrew?
Well, it's we always mention, Michael, that the regional markets tend to follow the energy that's coming out of the capital cities, the local capital city. And the latest data that we have, which looks at the growth rates over the past year with the current data, reinforce that. So if we look at New South Wales, firstly, Michael, we look at the top ranked 10 LGAs in New South Wales, and these are LGAs based on size. The top performer has been the Tweed, no surprise there, because we know the Gold Coast has been performing strongly. Well, Southeast Queensland's been performing strongly, driven to a large degree by all that COVID migration that we had
Yes.
through lockdown. But yeah, the Tweed up 10.7% over the past year. Wollongong and Newcastle have followed closely by. Wollongong up 8.3%, Newcastle up 8%. So really quite strong results everywhere except Albury and Dubbo, which were basically flat over the year. So again, it reflects that strong Sydney market, that most of the LGAs have performed positively over the past year, particularly those that are closest to Sydney, Wollongong and Newcastle, and the Tweed picking up on that Gold Coast energy, which has been very strong. Now, by contrast, when we look at Victoria, Michael, it's a different story. We only have 3 LGAs there that have recorded positive growth, and 2 of those are certainly the most affordable. That's Latrobe and Shepparton. Latrobe, the best performer, up by 5.9%, but it has the lowest median there of $450,000. So affordability is driven buyer activity in Latrobe. Bendigo up by 1.8% and Shepparton up 1.6%. But by contrast, The other LGAs closer to the Melbourne market have underperformed over the past year, particularly the higher price prestige markets. Mornington Peninsula and the Surf Coast, Michael, have been the underperformers, with the Surf Coast down by 7.7%. But that's been the story in Melbourne, where prestige markets have really been dragging the chain. Different story in Queensland. We know that southeast Queensland market's been very strong, Michael, on the basis of all that, certainly driven by all that migration. But when we look at all the LGAs, or the major LGAs in Queensland, up that eastern seaboard, we can see some very, very strong results. Rockhampton up 24.5%, Bundaberg up 21.7%, Townsville finally rising again, up by 21.3%. Gold Coast still up by 18.1%. The markets closer to Brisbane are certainly performing strongly. Toowoomba up 18.1%. All the major LGAs have recorded strong growth, even the Fraser Coast up by 5.4%. So it does reflect just how strong that Queensland market is, Michael, where all the LGAs are performing strongly. In Tasmania, we've got Hobart and Launceston up by 6.4% and 5.2% over the year, but Glenorchy and Clarence were down over the year, and Darwin leading the charge there in the Northern Territory, higher than Palmerston, which was flat over the year. So some interesting results there, Michael, for the regions. As I said, it's interesting that it does reinforce the energy that comes out of that capital city market. So part of the, I guess, economic confidence type factors, and we can see the disparity between particularly Queensland, very strong right across the board, and Victoria, where it's been certainly a lean bunch and only the affordable market. But that just shows you that affordability is still a positive in the Victorian housing market and the Melbourne housing market, and we still think that there's fertile ground for value there, particularly in that Melbourne market, and particularly given we're seeing some very strong rises in rents now in Melbourne, which are actually generating some very positive yields for investors. Those yields are rising strongly in Melbourne. Just looking back on that, on how strong Queensland is, I've got some data here, which I won't go through in a lot of depth, in terms of the greater Brisbane regions, of how strong their performances have been. I think a couple of notables there is when we look at Gold Coast units, for example, up by 11.5% over the year, which of course is a strong market, and also up by 4.7% for houses, the Gold Coast. So some strong results there for those greater Brisbane regions. And when we also look at rental growth over the past year, we've got rents rising quite strongly over, particularly in the Gold Coast, for units. So strong markets in Queensland and strong markets in southeast Queensland continuing.
Yes.
And as we've said here, Michael, we may see, in fact, I think we're sure to see the Brisbane median house price exceed $1 million this year, maybe pretty soon. And maybe on current trends, won't be too long before the Brisbane median house price is actually higher than the Melbourne median house price. So who would have believed that? But
Yes.
again, just reinforcing the value of that Melbourne market.
Well, the inbuilt value, the intrinsic value there, because that's going to eventually pick up as well.
Yeah,
but I do remember at the beginning of the year, you suggested that could be possible, but I don't know that many people believed it. But you've got a pretty good track record at picking these things. I just wanted to remind you that this is not specific investment advice, because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with my team at Metropole to discuss your goals, your options? We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. At Metropole, we're big enough to tip the scales in your favour, but still small enough to care. And since we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process, not an event. So you can't just go out and buy any property and hope to be successful. In fact, now more than ever, the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. Now, it was the last
Yes.
weekend of the autumn auction market, even though, as you said a bit earlier on, notionally, the autumn season goes on for a little bit longer in the
Yeah.
housing markets. How did the auction results go over the last weekend?
Well, certainly more positive results, Michael. We've really seen a consolidation of auction market activity over the past couple of months, despite all those holiday distractions that we usually get through April and into May. And of course, we had a very late Easter, sorry, a very early Easter this year at the end of March. But uh, I think that, I'm sort of getting used to, I'm getting a bit sick of or finding it difficult to find the same word for, stable results. But we had some interesting results again on the weekend, as you said, the last autumn weekend of auction activity. But we saw big numbers coming into the market in Sydney and Melbourne, 100 extra auctions in Sydney and 100 extra auctions in Melbourne. Really didn't affect the clearance rate. Sydney's clearance rate, again, stable, 73.3%, very consistent over the last month. Certainly a good result there for sellers, given the high numbers of auctions. But clearance rates are lower than where they were a year ago. We've also discussed this, Michael, that we would expect to see lower clearance rates going forward through this period, late autumn and into winter, because we had a boom market last year as buyers were flooding back into the market with those value opportunities that were generated by the weaker market in 2022 when interest rates increased. So our clearance rates aren't going to be as high, but the actual volumes are higher because we're seeing higher numbers of listings coming through. And you can see when we look at the auction numbers this year in Sydney and Melbourne compared to the same period, the same weekend last year, just how much higher they are. So holding firm in Sydney and Melbourne, still good reason, still a reasonable result there for the Melbourne market, and certainly the Melbourne markets that are sub-markets that are located around the value areas of Melbourne. We're talking the outer east, the west, the northwest, and the north are still producing quite strong clearance rates for sellers, high demand. Brisbane numbers down a little bit over the week, but clearance rates holding at nearly 60%. And as we've always said here, or consistently say here, above 50% is usually a good result for that Brisbane market, which has a different culture in terms of its auction attitudes compared to Sydney and Melbourne. Adelaide down a little bit with similar auction numbers, but still a good result there at 75.2%. And Canberra continuing to, I guess, tease us with signs that it's picking up, 66.6%, lower auction numbers, and around about where it was a year ago. But, we're waiting for that Canberra revival. It has been showing some signs of that occurring over the past month or so, but still really yet to get that sort of energy that Sydney's been showing and that typically it reflects. So when we look at the trends, Sydney's market a little bit lower than where it was same time last year, but certainly picked up on its results over April. Pretty consistent in Melbourne, down a little bit over May, and certainly well below where it was a year ago. A sort of a 50-50 market at the moment, Michael, in Melbourne, but it depends on the regions, as I discussed,
Yeah.
in
Yeah.
terms of the buyer scenario. Brisbane holding at that near 60% result, which is well below a year ago, but Brisbane was having a remarkable boom in property a year ago, and we've never seen these sort of clearance rates that we had a year ago, 70, 80%, but back to more of a normalised market. And as we've seen, there are plenty of signs there that Brisbane prices are still growing. Adelaide, a little bit lower again than a year ago, but still a seller's market there. And Canberra, yeah, maybe just starting to pick up a little bit, but we certainly have some water to go under the bridge before we can call a consistent revival in the Canberra market. And of course, you can get those auction clearance rates every Saturday night on my LinkedIn, the headline rates, my LinkedIn channel. Doc Andrew Wilson at LinkedIn at around 6:30, and of course Michael publishes the full national report, which has regional breakdowns for Melbourne and Sydney, as well as the top 10 sales for all the capital cities that sold under the hammer on the weekend. And as I mentioned, when we look at the actual number of sales that have occurred this year so far compared to last year, Michael, we can see record numbers of actual sales. So this reflects, even though clearance rates are a little lower, the significant increase we've had in the number of listings. And that reflects that this year's been a market for sellers coming into the market because they're now certainly confident in terms of their outcomes, whereas a year ago it was buyers coming into the market that pushed clearance rates up with lower listing numbers, certainly compared to where we are now. And of course, we always see that pattern in a reviving market because sellers have more skin in the game, so they take some time to regather their confidence in the marketplace. But we've certainly seen that in spades. So we can see nearly 30% more listings, or more, sorry, auction sales this year so far in Sydney compared to the same period last year. 20% more in Melbourne, 15% more in Brisbane, 10% more in Adelaide, and Canberra still dragging the chain with 4.7% fewer sales compared to the same period last year. So some very positive results continuing. As you mentioned, Michael, we'll have our May, our full May housing market or house price and unit price report out later in the week. So we look forward to that and see if we can continue the momentum that we've had with prices growth so far this year, which has been really, considering, 13 interest rate rises over the past 2 years, and it is 2 years. Markets have stood up very well indeed, and still some value in markets, still value in the Sydney market, and I think that's continuing to drive it, and certainly value in that Melbourne market, which we're starting to see those first early signs, which is higher rents and higher yields that will bring particularly investors back into the marketplace. And as we saw last week, the latest home loan data is very positive for investors.
Well, catch up with you again in a couple of days' time to get the My Housing Market end of May report. See you then.
Thanks, Michael.